Hey folks, it's Simon here with your Tao Daily video for Friday, the 2nd of August 2024. Markets got a bit of a dump yesterday following Wednesday's post-FOMC pump. I was actually surprised markets rallied as much as they did on Wednesday, given that 25 basis point rate cut was already pretty much baked in for September. Now, where does that leave us? Well, the S&P, if we just zoom in here, has from the low, it's rallied to 61.8% of the rally from the all-time high. All right, so that's basically all we need to do. All right, the SPY has come up. It's tagged the 61.8% retracement. It's filled this gap here. So it kind of has permission to roll over from here. Now, why did the market sell off yesterday? Well, I mean, we don't know for sure, but certainly weaker economic data is being highlighted as the smoking gun. Initial claims were higher than expected. Continuing claims were higher than expected. ISM manufacturing was weaker than expected. Construction spending was weaker than expected. And all of this is a potentially important paradigm shift for the markets. I say that because for the past several months, markets have tended to rally on weaker than expected economic data. All right, that's because weaker data ushers the promise of more rate cuts, right? Gives the Fed more ammo to cut rates if the economy is deteriorating. Okay, the fact that the market sold off on weaker economic data could mean that the market is now getting worried about continuing weakness and potentially risk of recession. All right, so that's an important shift from the market's mindset over the past several months. This is also expressed in bond yields, where we saw 10-year yields close below 4% for the first time in 6 months. Now, again, plunging bond yields have mostly been good for stocks, and particularly the Nasdaq. All right, tech stocks are perceived as kind of long duration assets, but the Nasdaq plunged significantly worse than the S&P yesterday. It was down nearly 2.5%. So if weaker bond yields and weaker economic data no longer kind of goose the market, that is potentially an important paradigm shift. Today we've got non-farm payrolls, where the street is looking for 180,000 new jobs to be created. My suspicion is if that number comes in lower, i.e. less jobs have been created, the market will take that negatively. All right, and we'll leave this bad news is good news paradigm. The street is also looking for a 4.1% unemployment rate, unchanged from the previous month. Again, if that comes in higher than expected, I think the market will take that negatively rather than positively. That's a wrap for today. I hope it helps, and I'll catch you next week.